Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. We're just doing a little kind of maybe educational, maybe very timely on the day in terms of the market episode today. I'd like to bring you Economics 1.18. Basically, how market economics work is that there's the economic, and a lot of you have heard me talk about this a little bit, but perhaps not quite in this way. There's the underlying reality, the economic fundamental ground. That is called Main Street. So what's going out there in the real world on Main Street, in factory industrial complexes, in suburban areas, in retail, obviously now over the internet too. But what the real economic activity, where people are selling real goods and services, that's Main Street. Wall Street is a very mixed up group of people who have all sorts of issues, as we all do, but it's kind of intensified there. And all they tend to do is go to an Ivy League school, learn something, and then repeat it for the rest of their life. They don't really learn to think for themselves like you do. So you have the advantage as the individual investor over the Wall Street guy. Why do you think we had a GFC? It was because Wall Street geniuses couldn't understand the common world, that in the real world, if an economy turned down, a large number of people could have trouble paying their mortgages. For them, they just did probability curves, mathematical equations, not look out the window at the real world, which is why I like to call what I do look out the window economics, applying common sense to the real world. Why this matters right now, this particular day, is that I did a couple of days ago, or especially in an article yesterday, I wrote about how that big rally on Wall Street was misplaced because it didn't really understand or take account of what Chairman Powell actually said. And if you listened to what he wrote in prepared remarks for his presentation, you'll see, and what he said at the time, you'll see that he was mostly wanting to highlight that interest rates are going a lot higher and they're going to stay up there for a long time. By the way, we may be able to reduce the rate that they're going up to 50 points, but be aware they're going a lot higher for a long time. But the headline was, Powell says it might be only 50-point rate hike. Then it became, Powell says we're slowing. So the reality got lost in this new world where people seem to have grown up. I don't know, I think gaming's the cause of all of this. We want a binary response. There's one thing that drives the market today or this week or this month, and we just want to react to that. Whatever the headline news is about that, let's react to that as quickly as we can. And then momentum models get involved, of course. The underlying reality of the global economy and the US economy especially, we just saw data yesterday showing what I've said was the case for many months now, that factory activity is in contraction. Now, it's just going to get worse. It has been getting worse for many months. Parts of the nation have been in a manufacturing recession for many months now. So it gets worse for Main Street USA. Meanwhile, Wall Street wants to have this binary response to any headline about what interest rates might do, forgetting that the correlation between interest rates and stock markets is not a thing. It's a cult. The reality is that interest rates and stock markets go in the same direction, are correlated about 50% of the time through history, and the 50% of the other time they're not. So does that mean there's a correlation? And also interest rates and the stock market tend to be reacting to the same stimuli, which is the economy. At the moment, we have a Federal Reserve Chairman, Powell, who doesn't care about the economy. He's having his own binary game. And his binary game is all about, I'm a good Federal Reserve Chairman if I beat inflation like Paul Volcker did in the 80s. So I'm going to hike interest rates up like Paul Volcker did. Remember, Volcker hiked rates to 14% to beat inflation, but inflation was 20. It's half that this time, roughly. I've said Fed could go to 7.5%, probably 6.5%. It's certainly not stopping where it is now, and even if it does 50-point rate hikes, it's just going to do a lot more of them to get there. So none of that's changed. The core indicator that the Federal Reserve likes, the PEC indicator, came out yesterday, 6%. It's 3 times higher than where they want that number. It's going to be a tremendous amount of interest rate hikes ahead of us. At the same time, coming back to look out the window, Main Street economic USA is in serious trouble. How to wrap this up? Okay, so what it means is there's always an elastic band, an invisible elastic band. Here, I'll show you. Usually you can't see it, but in this show, yes, you can. There it is. It's right there. And it can stretch. It's an elastic band. Here's the economic fundamental. Here's the stock market. So say, I love you won't get graphics like this anywhere else, people. So the market can swing negatively around the reality, and it can swing positively around the reality. At the moment, it's gone super positive. Well, it had until the start of this year, which is why I was bearish from the first week of January. And then it gets stretched too far and it has to come back. But the economy wasn't gaining and the stock market coming back. The economy continued to worsen and the stock market didn't go down fast enough. That's why the decline we've already seen in the stock market isn't enough to make up for how bad the Main Street economy of the USA is doing. In other words, stocks are more overpriced today than they were in the first week of January. And the Federal Reserve Chairman has his own binary game to completely destroy the US economy. He said he wants the employment outlook to weaken. He wants demand to weaken. He wants the economy to be below trend for a substantial period of time, and even more so to bring inflation down. He has said those things. And he's going to be hiking interest rates with only one game in town, inflation. So, as they did when they said inflation would be transitory and they didn't need to raise rates, at that time I said they're getting it wrong. They're going to end up raising rates too late and too aggressively. So again, I'm saying they're getting it wrong, and they won't see that the economy has really fallen off a cliff until it's too late. That's why the US is going to have another recession in 2023, and the stock market will be starting 2023 even more expensive to the underlying real world economy than it was at the start of 2023. And we saw what the stock market did this year. Stock market's going to go down even faster, as significantly or more significantly in 2023. The fabulous fact of the matter is we can trade that trend. And I've said it since the first week of January, protect your portfolio, take advantage of financial instruments available to make the most, protect your portfolio, all of your investments, and why not get an advantage with a downtrend? We can trade uptrends, downtrends. Trading is a noble pursuit because it provides liquidity. So while everyone else is buying, provide them some liquidity by shorting the market. It's a noble pursuit. Economics 118 comes to an end. I really think the stock market rally is already faltering. As I said, it probably would. If it does break down, it could break down very substantially. Do be careful in the stock market. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.